A small-town motel owner sits in a Mississippi coffee shop scribbling ideas on a napkin. That simple sketch would eventually become a $180 billion telecommunications empire. But hidden inside this corporate giant was an $11 billion lie, waiting to explode. This is the story of WorldCom and the accounting trick that fooled absolutely everyone. Stay with me because what happens next changed business history forever. Picture the year 1983 in Hattiesburg, Mississippi on a regular afternoon. Bernard Ebbers meets with a friend named Murray Waldron at a local coffee shop. Waldron draws up a wild business plan right there on a paper napkin. The idea was simple but brilliant at the time to sell cheap long-distance calls. Ebbers and a few investors scraped together $650,000 to get started. They launched a company called Long Distance Discount Services, which everyone just called LDDS. By 1985, Ebbers takes over as Chief Executive Officer of this small operation. Now here is where things get interesting because Ebbers was no typical corporate executive. They called him the Telecom Cowboy because he wore jeans and boots to boardrooms. He lived on a farm, drove tractors, and started corporate meetings with prayer sessions. This was a man who had bounced around in life before finding his calling. Born in Canada in 1941, Ebbers grew up in a working-class family. His family moved around constantly, even living on a Navajo reservation in New Mexico. He went to college on a basketball scholarship, but an injury ended that dream. So he coached junior varsity basketball and earned a degree in physical education instead. After college, he did what many young people do and tried different odd jobs. He worked as a milkman and even bounced at bars to make ends meet. Then, he bought some motels in Mississippi and ran them successfully for several years. But that napkin sketch in the coffee shop would change everything for Bernard Ebbers. The telecom industry in the 1980s was ripe for hungry, aggressive newcomers. Ebbers had an insatiable appetite for growth and he found it through acquisitions. His strategy was deceptively simple in concept but brilliantly executed at the time. Buy a competitor, integrate their networks and customer base, then find the next target. Between 1983 and 1995, LDDS gobbled up over 60 telecommunications companies. In 1995, they renamed the company WorldCom to reflect their grand ambitions. The name change was not just cosmetic because this company was about to explode. Wall Street began to notice this crappy telecom company delivering impressive growth numbers consistently. Stock analysts started making strong buy recommendations and investors piled into WorldCom shares eagerly. The stock price climbed from pennies per share to over $60 by 1997. But Ebbers was not satisfied with being just another successful telecommunications company executive. He wanted WorldCom to become the undisputed king of the entire telecommunications industry. In 1996, WorldCom acquired MFS Communications, which had built massive fiber optic networks. Then came the crown jewel acquisition that would make corporate history around the world. In 1997, WorldCom announced a $37 billion merger with MCI Communications. This was the largest corporate merger in United States history at that time. WorldCom had outbid British Telecom and GTE to grab MCI by a wide margin. The deal closed in September 1998, creating a telecommunications powerhouse called MCI WorldCom. At its absolute peak in 1999, WorldCom had a market capitalization of $180 billion. The stock hit its all-time high of $64.50 on June 21, 1999. Bernard Ebbers was now worth an estimated $1.4 billion personally. He owned the largest ranch in Canada, spanning 500,000 acres in British Columbia. He had luxury yachts, timber companies, hotels, and even a minor league hockey team. Life at the top seemed absolutely perfect for the telecom cowboy from Mississippi. But behind the glamorous facade, cracks were already forming in the WorldCom empire. The dot-com bubble began bursting around the year 2000, devastating technology stocks everywhere. Telecommunications demand slowed dramatically as businesses cut back on their expansion plans suddenly. WorldCom had built massive fiber optic networks, expecting explosive growth that never actually materialized. The company was bleeding money, but Wall Street still expected consistent profit growth quarterly. Ebbers faced a personal financial crisis because he had borrowed heavily against his shares. As the stock price tumbled, margin calls started hitting him hard and relentlessly. The WorldCom board of directors authorized over $400 million in loans to Ebbers. They did not want their CEO dumping shares which would further crash the stock. Meanwhile, the company attempted another massive acquisition to keep the growth story alive. WorldCom tried to buy Sprint Corporation in a deal worth $115 billion. But United States and European antitrust regulators blocked the merger in July 2000. Without new acquisitions to fuel growth, WorldCom had no clear path forward anymore. The pressure on executives to hit Wall Street targets became absolutely unbearable and intense. Here is where the accounting trick begins, and this part is absolutely fascinating. Scott Sullivan was WorldCom's chief financial officer, and he was fiercely loyal to Ebbers. Sullivan had joined WorldCom from Arthur Andersen and quickly rose through the finance ranks. He faced an impossible situation because real earnings were falling far short of targets. The revenue was declining, but Wall Street expected profits to keep growing every quarter. So Sullivan devised a scheme that was elegant in its simplicity but deeply fraudulent. The trick centered on something called line costs, which are fees to lease phone networks. Every telecom company pays other carriers to use their lines for transmitting calls. Under proper accounting rules, these line costs are operating expenses recorded immediately each quarter. They hit the income statement right away and reduce profits in that same period. But Sullivan had a different idea that would make expenses magically disappear temporarily. He instructed accountants to reclassify these line costs as capital expenditures on the balance sheet. Capital expenditures are assets that provide benefits over multiple years, not just one quarter. Think of buying equipment that lasts a decade versus paying monthly electricity bills. By capitalizing line costs, WorldCom could spread the expense over many future periods. This immediately boosted current quarter profits because less expense hit the income statement. They even invented a fictional term called prepaid capacity to describe these fake assets. The prepaid capacity entries had absolutely no basis in generally accepted accounting principles whatsoever. Nobody outside a small circle of executives even understood what prepaid capacity actually meant. When questioned, accountants who made the entries admitted they had no supporting documentation at all. They were simply following orders from David Myers, the corporate controller, without asking questions. Myers in turn was following direct instructions from CFO Scott Sullivan to book these entries. Some of the entries were even labeled SS entry, indicating Sullivan had explicitly directed them. The fraud started small in late 1999 but quickly snowballed into billions of dollars. To avoid detection, the entries were often made at night when fewer people were around. Accountants like Betty Vinson were uncomfortable but feared losing their jobs if they refused. She later testified that she booked entries without understanding their purpose or seeing documentation. The culture of fear and blind obedience allowed this fraud to continue for years. By early 2002, WorldCom had moved over $3.8 billion fraudulently, but the total fraud would eventually grow to over $11 billion when fully investigated. This made WorldCom the largest accounting fraud in American history at that time. For comparison, Enron, which collapsed just months earlier, had overstated assets by less than WorldCom. Now let me tell you about the hero who brought this entire house of cards down. Cynthia Cooper was the Vice President of Internal Audit at WorldCom headquarters in Mississippi. She was a Mississippi native, just like Ebbers, but with a very different moral compass. Cooper had joined WorldCom in the early 1990s and built the internal audit team. Internal auditors are supposed to be the watchdogs who catch problems before they explode. In May 2002, one of Cooper's audit managers named Glynn Smith read something interesting. An article in Fort Worth Weekly mentioned a former WorldCom analyst named Kim Emig. Emig had tried to blow the whistle back in 2000 but was laid off instead. He had noticed that labor costs were being improperly classified as capital expenditures back then. This article made Smith suggest to Cooper that they start the capital expenditure audit early. Cooper agreed and her team began digging into WorldCom's books in late May. What they found would shock them and eventually shock the entire financial world completely. During the audit, corporate finance director Sanjeev Sethi mentioned something called prepaid capacity. Cooper had never heard this term before and asked Sethi to explain it. Surprisingly, Sethi claimed he did not understand the term despite his role approving capital spending. This was a massive red flag that something very wrong was happening at WorldCom. Cooper assigned Eugene Morse, an accountant with technical skills, to trace these mysterious entries. Morse searched the accounting system and found unusual movements of large amounts between accounts. The audit team used basic accounting techniques to trace funds moving in irregular patterns. They discovered money was flowing from the income statement to the balance sheet improperly. CFO Scott Sullivan caught wind of the audit and tried to shut it down. He requested that Cooper postpone the capital expenditure audit until the third quarter of 2002. Sullivan claimed he was planning a restructuring charge that would clean everything up nicely. But Cooper refused to back down despite the pressure from the company's top finance executive. To avoid detection, the audit team began working at night after normal business hours. They knew increased server activity from data extraction during the day would raise suspicions. On June 10, 2002, they discovered the prepaid capacity entries showing massive transfers. The transfers had moved billions from line cost expenses to asset accounts fraudulently. Cooper contacted Max Bobbitt, who was the chairman of WorldCom's board audit committee, directly. Bobbitt connected her with Farrell Malone from KPMG, the company's new external auditor. KPMG had recently acquired Arthur Andersen's WorldCom account after Andersen's collapse from the Enron scandal. The external auditors examined the entries and found no support under accounting standards whatsoever. Kenny Avery from Andersen confirmed that no accounting principles allowed capitalizing line costs this way. When confronted, accounting director Betty Vinson admitted she processed entries without understanding their purpose. Controller David Myers confessed there was no support for the entries under accounting standards. Myers said they booked entries based on what they thought margins should be. He admitted the entries should not have been made, but it became hard to stop. On June 20, 2002, the audit committee held a critical meeting. Sullivan presented a white paper trying to justify his accounting decisions with business reasoning. He argued that WorldCom had invested heavily expecting customer growth that never materialized. Sullivan claimed the matching principle allowed costs to align with future asset benefits. The committee and KPMG rejected this argument completely, finding no accounting basis for the entries. They concluded the transfers were made solely to meet Wall Street analyst targets fraudulently. Arthur Andersen withdrew its audit opinion for 2001 financial statements immediately. On June 25, 2002, the board demanded resignations from Sullivan and Myers. Myers resigned, but Sullivan refused, so the board terminated him on the spot. That same day, WorldCom executives briefed the Securities and Exchange Commission about the fraud. WorldCom publicly announced it had overstated income by $3.8 billion initially. The stock price, which had already fallen 94%, crashed to just pennies per share. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection. The company listed $104 billion in assets, making it the largest bankruptcy ever. More than 17,000 employees lost their jobs in the aftermath of the scandal. Investors lost approximately $180 billion as the stock became worthless paper. Retirement accounts that had been heavily invested in WorldCom stock were completely wiped out. The criminal trials that followed gripped the nation and sent shockwaves through corporate America. Scott Sullivan pleaded guilty and agreed to testify against his former boss, Bernard Ebbers. Sullivan claimed that Ebbers knew everything about the fraud despite his claims of ignorance. On March 15, 2005, a jury found Ebbers guilty of fraud and conspiracy. He was also convicted of filing false documents with securities regulators 7 separate times. On July 13, 2005, federal judge Barbara Jones sentenced Ebbers to 25 years in prison. For a 63-year-old man with heart problems, this was essentially a life sentence. Ebbers drove himself to Oakdale Federal Correctional Institution in Louisiana in his Mercedes-Benz. Betty Vinson and other accountants who followed orders received lighter sentences, including probation. Ebbers served 13 years of his sentence before being granted compassionate release in December 2019. He was legally blind and suffering from dementia by the time he left prison. Bernard Ebbers died on February 2, 2020, just weeks after his release. He had lost everything, including his ranches, yachts, hotels, and nearly all personal assets. His wife was left with an estimated $50,000 in known assets. From billionaire to bankrupt, the fall of Bernard Ebbers was complete and devastating. Cynthia Cooper became a hero and was named Time Magazine Person of the Year for 2002. She shared that honor with Sharon Watkins from Enron and FBI agent Colleen Rowley. Cooper later wrote a book about her experience and became a speaker on corporate ethics. She proved that one determined person with integrity can bring down even the mightiest fraud. The WorldCom scandal, along with Enron, triggered massive changes in corporate governance laws. Congress passed the Sarbanes-Oxley Act of 2002 in direct response to these frauds. SOX, as it is commonly called, requires executives to personally certify financial statements are accurate. It established the Public Company Accounting Oversight Board to supervise external auditors more strictly. Whistleblower protections were dramatically strengthened to encourage people like Cooper to come forward safely. Companies must now maintain robust internal controls and have independent audit committees with real power. What remained of WorldCom emerged from bankruptcy in 2004, renamed simply MCI. Verizon Communications purchased MCI in January 2006 for $7.6 billion. That was a fraction of WorldCom's former $180 billion market capitalization. Creditors received only pennies on the dollar for the $35 billion in debt owed. Shareholders got virtually nothing after years of litigation and bankruptcy proceedings dragged on. A class action lawsuit eventually recovered over $6 billion from various defendants. This money came from investment banks, former board members, and auditors who missed the fraud. But $6 billion was a tiny fraction of the $180 billion investors originally lost. So what lessons can we learn from the spectacular collapse of WorldCom today? First, blind pursuit of growth at any cost will eventually lead to disaster. Ebbers was addicted to acquisitions because they masked fundamental problems in the business model. When acquisitions stopped, the fraud began because there was no other way to meet targets. Second, the culture at the top sets the tone for the entire organization. Ebbers created an environment where hitting numbers mattered more than how you hit them. Accountants who raised concerns were ignored, fired, or pressured until they fell in line. Third, internal auditors and whistleblowers are essential safeguards against corporate fraud everywhere. Without Cynthia Cooper's courage, this fraud might have continued for years longer undetected. Companies must empower their internal audit functions and protect those who speak up bravely. Fourth, external auditors must maintain true independence and professional skepticism at all times. Arthur Andersen completely missed this fraud despite auditing WorldCom for years before the scandal. They never tested whether capitalizing line costs was appropriate under accounting standards properly. Fifth, investors should be skeptical of companies that consistently deliver perfect results every quarter. Real businesses have ups and downs, and perfect numbers can sometimes indicate manipulation. The WorldCom story proves that even the mightiest corporations can be built on lies. One napkin sketch created a telecommunications empire worth nearly $200 billion. One accounting trick destroyed that empire and ruined thousands of lives in the process. Bernard Ebbers went from Telecom Cowboy billionaire to dying blind and broken in disgrace. Cynthia Cooper went from unknown internal auditor to celebrated hero of corporate governance. The $11 billion lie at WorldCom fooled everyone except one determined woman with integrity. And that is why this story still matters more than 2 decades later today. If you found this story valuable, make sure to subscribe for more business history content. Hit that like button if you learned something new about one of history's biggest frauds, and drop a comment below telling me which corporate scandal you want me to cover next. Thanks for watching, and I will see you in the next one.